When it comes to specially designed whole life insurance policies designed for cash value accumulation, there are a few components that are involved. And when you have premium deposits or money that you're looking to put back into the policy, you may be wondering, what is the order in which it should be applied? Should I pay my premium first? Should I pay the loan interest? Should I pay that loan principal? What is the order of operations when it comes to putting money back into your policy? And that is exactly what we're going to cover today. So stick around to the end of this video. I'm Olivia Kirk.
I'm Tim Urich. We're from Tier 1 Capital, and we're here to show you how to regain control of your money.
For the best advice on controlling your cash flow, be sure to subscribe to our channel and don't forget to hit that bell to be notified when we upload new videos twice every single week.
So you have extra money, you have an outstanding life insurance policy loan, and you're wondering, should I pay off the loan? Should I pay my base premium? What is the best way to utilize this extra money? Check out our latest blog post. We do a deep dive on the best order for extra money going back into a policy. We'll see you there. So you have some extra money, you want to put it back into your policy, but you're not exactly sure which is the best place to put it. Should you put it on the base premium? Should you put it on the paid up additions rider? Should you pay the policy loan interest? Or should you pay the policy loan principal?
When it comes to policies, there is an order of operations, an order in which you should apply your funds, because some funds have more bang than other funds. First of all, you pay your base policy premium. This is the regular, whole life, off-the-shelf piece of your policy.
And that's important because in the beginning, the base policy is not very efficient. In fact, for every dollar of base premium in the first 2 years, in all probability, you won't have 1 penny of cash value after the first 2 years on the base policy. But here's the point. As time goes by, that base policy becomes incredibly efficient to the point where down the line, 20, 30, 40 years, every dollar you put into the policy's base premium could be generating 4, 5, 6, even 7 times that premium. So you always want to put money in the base premium when you have extra money.
And you may be wondering, why is that the case? How could I be putting in $1 and it multiplying on a guaranteed basis by 2, 3, 4, or 5 times? And it's simple. These policies are actuarially designed. They're designed to meet 2 promises. The first promise the insurance company is making you is to pay that death benefit when the insured dies, anywhere along the line, as long as that policy is enforced. The second promise says that at the age of maturity, whether that be age 100 or 121, depending on your contract, the insurance company is going to have a cash value equal to that death benefit. So what that translates to is every single year, the insurance company needs to stash away more and more cash in order to meet that second promise, that second guarantee to you, the policy owner.
And again, that is the engine that makes these policies so effective for long-term capital accumulation.
Leave us a comment down below. How are you currently using your life insurance policy? We'd love to hear how you're putting your dollars to work. Now, the second piece we're going to talk about is the paid up additions rider. This is the rider that allows us to accumulate more cash early on in those policies. So when you make your initial premium deposit, you're not going to have a big old zero as far as cash value. You're going to have access to a portion of your premium deposits.
And if you think about it, the paid up additions rider makes up for the lack of efficiency in the base policy in the early years. As time goes by, the effectiveness of the paid up additions rider isn't quite as great as it was in the beginning because the base policy starts to take over.
Depending on the policy design, your paid up additions rider may go from year 1 all the way to year 10, possibly beyond, but after year 10, you may be questioning, is it worth putting money into that paid up additions rider? So if you're within years 1 through 10, certainly put that money into the paid up additions rider as the second priority. But after year 10, you may not want to continue to contribute to that paid up additions rider and just let that rider die off.
So here's the point on the 10-year mark of deciding whether or not to put extra money into the paid up additions rider. Whether you put the money in the original policy or you start a new policy, those dollars allocated to the paid up additions rider will have about the same rate of return. Paid up additions rider, whether it's in policy A or policy B, doesn't matter. It's going to have about the same rate of return. You have an extra dollar, put it in the base premium. You have $2 extra, put it in the base premium and the paid up additions rider, which takes us to the third order of efficiency when you're looking at putting extra money into a life insurance policy. The third dollar should go to paying the loan interest. Now, why the loan interest? It's real simple. That interest is a cost. You're paying that interest directly to the life insurance company, and they will, hopefully, if they make a profit, funnel some of that money back to you in the form of tax-free dividends. But there's no guarantee on that. So if you can avoid that cost from having that cost build or grow over time, by all means, put that extra money on paying the loan interest.
And you may be wondering, why do we have that cost associated with the policy loan? Why doesn't that interest just go back to your policy? And that's real simple. It's the way policy loans work. When you request a policy loan from the insurance company, you're taking a loan from the insurance company's general account. And the insurance company then places a lien against the cash value in your policy. So this means that the money never actually leaves your policy. It's able to accrue uninterrupted compound interest as if the money never left that account. Because it didn't. It came from the insurance company. Now, accessing other people's money, we know, has a cost. And that's why we pay the insurance company versus paying ourselves.
But the nice, neat little package you have here is when you take a loan against the equity of your policy, against the cash value of your policy, it's a collateralized loan. So the money in your policy is allowed to grow uninterrupted compounding of interest. And then that separate loan from the insurance company is being amortized, if you're paying it back, on a declining balance. And now you have this phenomenon where you have this arbitrage, if you will, between amortized interest being paid on a declining balance and compounded interest growing on an increasing balance. Another area of control is the fact that if you run into a cash flow issue, you could stop those payments back to the policy for the policy loan because it's an unstructured loan. You decide, you're in control if and when you pay that loan back.
And the last in the order is paying back that policy loan principal. And the reason why is because it's only reducing the lien against the cash value in your policy. Meaning, for every dollar you pay back towards that loan, your cash value accessibility increases by just $1. It doesn't compound, it doesn't grow over time. It just releases that $1 of lien against the cash value.
So think of it this way. This is your loan balance. This is your policy equity. Every dollar you put into the loan balance reduces it and correspondingly increases the policy equity. So as you pay that loan balance down, your equity, the equity you're able to borrow against, grows. So now if you need the money again, boom, you're back in business. Why? Because every dollar you paid on the loan increased the amount of equity that you have or that you could access.
If you'd like to learn more about how to put your policy to best use for you, or if you're interested in getting one of these specially designed whole life insurance policies designed for cash value accumulation, be sure to check out our website at tier1capital.com. Feel free to hop on our calendar using the schedule your free strategy session button right on our homepage. Also, if you like this video, be sure to check out these two. We picked them out special for you.
Thanks so much for watching our video. And remember, it's not how much money you make.
It's how much money you keep that really matters. We'll see you in the next one.